be the most important video I've ever made because it describes basically what I've been looking into for the last 6 months, confirms a lot of it, and does a lot of the work for me as far as the last 90 years is concerned, and it confirms a lot of our current strategy that we're working with in the trading group that I'm in. I'm sure you've heard of it. If you haven't, it's not a big deal, but the whole way we operate is around gaps, okay? And I wanted to go over this and explain the thought process, and just to reiterate how unprecedented the time is in today's market and how much of an edge exists out there in the market, strictly due to the tools, resources that have become readily available to the retail trading person since this report was written. This report we're going to be looking at was written in 2018. It was published in 2019, and it looked at data from 1928, to 2018. So 90 years of observation here. So let's go ahead and take a look at this. I'll link this below if you'd like to read this in full. This is the price gap anomaly in the United States stock market, the whole story. Now, abstract. This paper analyzes the price gap anomaly in the United States stock market, comprised of the Dow Jones Index, S&P 500, and NASDAQ. Nothing's changed there. Covering the period 1928 to 2018. This paper aims to investigate whether or not price gaps create market inefficiencies. Price gaps occur when the current day's opening price is different from the previous day's closing price due to orders placed before the opening of the market. So basically they're saying it happens in after hours or in pre-market, and that still is the case today. So the good news about this, before I go any further, is we've already put in a lot of the work that this paper ended with. We picked up the baton where this paper ended up or left off, and we're running with it as today, in today's world. So again, price gaps occur when the current day's opening price is different from the previous day's closing price due to orders placed before the opening of the market. Several hypotheses are tested using various statistical tests, such as the student's t-test, ANOVA, Mann-Whitney test, regression analysis, and special methods, that is, the modified cumulative returns and the trading simulation approaches. We find strong evidence in favor of abnormal price movements after price gaps. Remember, key component of our group, after earnings, not before earnings, because what have we learned? It's best to play after the gap, not before. So we can go ahead and check that box and say that's still the case today. So a trading strategy based on this anomaly was efficient in that its results were not random, indicating that this market was not efficient. The momentum effect was found to be temporary, and no evidence of seasonality in price gaps was found. Lastly, our results were also contrary to the myth that price gaps tend to get filled, which we've seen that as well in our group. Now, the keywords to this, which is funny, and the reason why I took a snippet of this, is because momentum, that is all we're playing off of. If we're playing options and the price is X, all we're wanting the price to do, if we're buying in the money as our strategy calls for, all we need to profit is momentum in the direction we're playing. So if we have puts, we want downside momentum as soon as we can get it after we make the purchase. If it doesn't happen, then you lose value naturally over time, especially if it goes against you. But the thing with options, you can sit there and hold it. Even if the stock trades sideways, you will still lose money because of theta. That is why you want the protection of intrinsic value being in the money when playing this strategy specifically. Because you're just looking for that momentum that is created naturally by the gap existing and its characteristics in the first place. Momentum. Okay, so introduction, and don't worry, this is real short. The efficient market hypothesis contends that markets are efficient when prices reflect all relevant information. This has been empirically shown not to be the case by academics and practitioners. Now, anomalies in their various forms exist in the international stock markets. The study of anomalies, therefore, remains an active area in the finance literature, including that of price anomalies. And I apologize, I am terrible with foreign names, so I apologize in advance. According to Caporal and Platson, 2017, price gaps occur when the current day's opening price is different from the previous day's closing price due to the orders placed before the opening of the market. The empirical literature on the price gap anomaly is broadly focused on the confirmation of this anomaly. See Yuan 2015 and Caporal et al. In 2016, for example, which I'm going to be looking into every single one of these references. And the ascertainment of exploitable profits, which may arise, again, see Caporal and Platson 2017 and Platson et al. 2019a. However, this literature remains limited in terms of its application to the U.S. stock market. Limited. Now, a study of this nature, focusing on such a long period in the United States stock market, has not been conducted previously, constituting a gap in the literature. Let's see what they did there. To this end, following is a brief review of the relevant literature, a discussion on the data, and the methodology, the results, and a conclusion. Perfect. It's not just someone on the internet telling you something, hey dude, we're going to do this because reasons. No, this is what it's all about. Now, literacy review. 3 types of anomalies have been studied in the literature, that is, seasonal, size, and price anomalies. According to Bildick, 2004, anomalies indicate market inefficiency or inadequacies in the underlying asset pricing model. That's the key, and tend to disappear after discovery as traders adapt to their existence. There are numerous reasons for the existence of anomalies. For example, Basu in 1977 identified price anomalies by discovering that value stocks had higher risk-adjusted returns compared to growth stocks. Now, is that the case today? I don't know. I haven't looked into it. You got to understand, when reading stuff like this, excuse me, when you get dates all the way back in 1977, it's 2022. So you would have to get and get yourself up to date with any literature that's came out between now and then. Now, the price gap anomaly falls within this categorization of anomalies. The price gap anomaly is in essence related to the day of the week effect. Cross 1973 was the first to confirm that the distribution of stock prices changes according to the day of the week, and in particular between Friday and Monday. Others such as Cross 1973, Gibbons and Hess 1981, Kai et al. In 2006, French 1980, and Agrawal and Tandon 1994 find that the day of the week effect was indeed most pronounced on Fridays and Mondays. This is otherwise known as the weekend effect, as studied by Fortune 1999 and Fortune 1998, amongst others. In summary, Caporal and Platson 2017 cite the following as the most common reasons for the existence of price gaps. Now keep in mind what we've been doing in our group. Keep in mind, earnings, significant time differences between closing and opening prices caused by holidays and weekends. Okay, that's understandable. The advent of after-hours trading. That's a really good point. I need to look into when that was created. Unexpected events that have a bearing on security prices, such as earnings and profit warning reports. And by the way, I haven't fucking read this yet. I'm reading this for the first time with you. So this is jacking my tits right now. But that's great. Look at it. So this still applies. That's our whole bread and butter. It still applies. Unexpected events that have bearing on a security's price, such as earnings and profit warning reports. Market shocks that can cause significant and sudden shifts in the supply and demand of financial assets, and other reasons. That's vague. He probably doesn't want to tell you. Now, however, studies investigating the overreaction hypothesis, which is exactly what we've been doing, Large market opening price changes followed by a significant correction are more common. See Grant et al. 2005, Fung et al. 2010, and Caporal et al. 2016, amongst others. For example, Grant et al. In 2005 in the U.S. stock index futures market over 15 years found that significant intraday price reversals and also that the strength of the overreaction was more pronounced with large positive opening market price changes. However, Grant et al. 2005 could not conclude if the price gap anomaly led to exploitable profits. Well, we've already proven this shit to an 85% win rate. Now, determining whether the price gap anomaly generates exploitable profits remains a gap in the literature, which we need to pick up the slack and fill as a group. According to Jensen 1978, for an anomaly to be statistically significant, it must generate excess returns. Only recent Platson et al. 2019b applied the trading simulation approach to the Ukraine stock market and found that a trading strategy based on the price gap anomaly generate profits. Now, these were the hypotheses drawn by this article or by this study. You had hypothesis 1, price gap anomalies exist. Also H1-1, prices tend to rise after positive gaps. And remember, a hypothesis, this is what they were formulating before they started the study. This is what they're assuming based on their current knowledge of this topic. So we have hypothesis 1, where we have price gaps exist and they tend to rise after positive gaps. We have hypothesis 2. Hypothesis 2. Hypothesis 1-2, sorry. Prices tend to fall after negative gaps. So that applies to H1. So in total, H1 is saying anomalies exist, they tend to rise after positive gaps, and they tend to fall after negative gaps. Hypothesis 2 declares that price gap anomalies evolve. Oh, I think I missed one. Where is H3? Sorry about that. Let me get the third one. I want to make sure I get you all three. H3. Okay, H3 is there is seasonality in price gaps. Okay, so we have seasonality. They exist. They gap up, or they turn positive after gaps ups and negative after gap downs. The price keeps moving down after gap downs. Price keeps moving up after gaps up. They exist, they have seasonality, and they evolve. Those are the hypotheses. So now we have table 1. We have the parameters measured were the Dow Jones Index, the S&P 500, and the NASDAQ. Observations for Dow Jones, 8590. S&P 500, 23,893, and then the NASDAQ had 17,700 observations. And if you want to pause and read the rest of the data, you can. Or again, this will be in the description if you'd like to download or read this yourself. Now, the testing of this, the period, you have a date range here on the left-hand side. Gap type, down, up, the number of trades units, number of successful trades units, number of successful trades percent, profit percent per year, z-test, and then result. Only during one period of time did it fail, based on their model. 1939 through 1948. I think that was World War, right? I'm not 100% on that, but sounds about right. Now, profit percent per year, not the greatest, but not the worst. Number of successful trades, look, it's been decreasing since they started the study, or since the data. So, they must be doing something wrong, or they must have evolved, like they've said. Obviously, if the number of successful trades started here at the beginning, when this test data was started, initiated, and now we're at 60%, well, how are we trading in our group at an 85% win rate? Because we're doing something different, because it evolved. So if this doesn't line up with every effing thing we've been doing for the last 6 months, I don't know what does. Now, price gap evolution. Overall, in probabilistic terms, price gaps do not generate any stable patterns, but there can be patterns in terms of size of price movements after gaps. That is exactly what we're doing. It's not about the gaps filling. It's about the size of the movement after the gaps to exploit the profit potential. To check this, we will test H1 and H2, which again, H1 is that they exist. They go up after gapping up and go down after gapping down. H2 is that they evolve. To incorporate price direction in results of analysis H1, we further test for H1-1 and H1-2, the up to up, down to down hypothesis. The results for the overall data sets are presented in appendices C to E for the cases of Dow Jones Index and S&P 500 and NASDAQ respectively. To ease the interpretation of results, we have summarized them in Table 5 and Table A.3. You'll want to look at that at the end of the video and in the description. I'm not going to go over any of that stuff. I'm just going over the bread and potato or meat and potatoes of the gap strategy that they were testing. Now, we're going to skip the rest of this here. We're just going to go to the conclusion. Right here, this Table 5 suggests that price gap anomaly may evolve and is, therefore, a preliminary confirmation of H2. So, Table 6 and 7 confirm H1-1 in the S&P 500 on the day of the price gap. Fucking A, dude. That is, on the price gap day, prices tend towards the direction of the price gap. However, this is not the case for the day after the gap price. Therefore, H1-2 is not confirmed. And H1-2 was that gaps go up, continue to go up. But in today's markets, what have you seen? This is where your observation and your time spent in this group, looking at these gaps, remembering what we've been doing and doing it the same way every time, this is where all of that shit comes in handy, because now we can think about it and we can recall on what we've been seeing and studying and trading for the last 3 months. And we can be like, okay, what happens after gaps? We fucking know like the back of our hand. After a gap happens on earnings, between day 2 and 5, it tries to correct the RSI, because they did not include any RSI calculations in this. So when we add in the RSI, we notice something. We notice that when these gaps happen on earnings, the RSI either becomes oversold or overbought. And that is an issue, right? So that's got to be corrected. And that's the whole theory on why we play directly after the gaps. And that's why we have an easy way to screen for them. And again, reading this now, that was a study from 1928 until basically 4 years ago, is insane. And now, what else is insane? Think about the amount of shit that's changed between 2018 and today. This article was dropped in August of 2019, literally the month before COVID started, and the Fed took over as the lender of last resort. So think of what's changed since then. Everything. The quality of data is improved, the amount of data is improved, the accessibility to data is improved, the quality of our apps is insane compared to what we had a few years ago. I mean, you got tick charts now, you got 1 second charts now, you got drawing tools, you have all kinds of shit at your disposal on top of the internet and peers around you with the same access to the same information. And in my opinion, this is one of the most underrated things that exists for humanity. And I don't feel like a lot of people are utilizing it. There's the availability of the tools around you, because everyone would rather sit on social media and pretend like they know and pretend like they have a hero that they know. But in reality, no one's going to ever know until they put the work in. And look, that's all I've been trying to say. Now, the conclusion: we analyzed price gap anomaly in the U.S. stock market by using information from 3 stock market indexes, the 3 major ones. We tested 3 hypotheses of interest. Again, H1, the price gap anomaly exists. H1-1, prices tend to rise after positive gaps. H-2, H1-2, prices tend to fall after negative gaps. H2, the price gap anomaly evolves. And H3, there is seasonality in price gaps. Well, we could have told you before we even read this paper that we knew H3 was bullshit, because this has been consistently happening the same way for 4 or 5 months now. Now, various statistical methods, including parametric tests, student t-test and ANOVA, non-parametric tests such as the Mann-Whitney test, regression analysis with dummy variables, MCAR approach, and the trading simulation approach were utilized. We conclude that the U.S. stock market in the main did not exhibit seasonality and price gaps. Therefore, H3 is rejected. Furthermore, no evidence was found that price gaps in the United States stock market were filled within 5 days of their occurrence. But what have we been trading on? 2 to 5 day, not fills, I'm sorry. We've been trading on 2 to 5 day momentum. That is why I've been screaming, we're not playing fills, we're playing off momentum. Because even here, they were not filled within 5 days. So they had an assumption in their mind when at the time of this study that the gaps would be filling in this amount of time. What we clearly see now, and I'm about to show you what we see now, because you already know what we see now. We've been looking at it forever. But so they didn't find any evidence that they fill, right? And that agrees with what we still see today. However, strong evidence in favor of abnormal price movement after the gap were found, confirming H1 and H2. So there you go. And this is, again, concluded in 2018. So now, if you look at gaps today, hearing everything you just heard from this study that was conducted from a 90-year period on the 3 major indexes which we know control most of the market, what do you see in today's gap mechanics, gap characteristics? What do you see? Well, first, if you don't know, you should go look, because it's insane. Now, again, our strategy pertains to the daily, which is important. Look at the non-daily. Different scenario than what I'm about to show you. But what I'm about to show you is where I think the true mechanics exist. This was earnings right here. If you would have bought on the low of this day here, and then sold at the high here, or here, you probably want to do it here. That's exactly what a lot of us did in the group. Most of us on Kirk, we either bought here, or like me, I got lucky. This was like the very first play that I tested out with this strategy. One of the very first, it was Kirk. I didn't buy on day 1. I bought on day 2 at the low, near the low. I think I got it, I didn't get the wick. The wick's always crime candles, but I got it, basically at the end of this body. Okay, and then remember, day 2 to 5, bought day 2, sold day 5. I was up 108%. It was a badass trade. And then I played it again here, and I sold it here for another. It was like 40 or 50% there. And then I sold, and I should have bought some more further out. But the point is, what do you notice, and what have I been trying to show you about these gaps and what they act as? They're fucking support and resistance. That is what they are. Now, what they're creating in between is something entirely different, and there's answers for all of this. The reason why a gap exists above and below most stocks right now is because they've been transitioning to a corridor style system, which means a floor and a ceiling for monetary policy, which is exactly what we've had come out in the last 3 years since this was written, this report. So think about it. Since this report was written, they've literally been going full speed away from their previous model system into a corridor system. And what do you see all over the market? Corridors of floors and ceilings. So I'm just saying, complacency is not a thing to have right now in these markets. With the unprecedented of tools, again, data, I can't say this enough, there is no reason to sit there and pretend like nothing new can ever be created, that no new ideas can happen, that nothing new ever happens. That is the most retarded shit I've ever heard. That is a cop-out, an excuse. If you don't see the power that we have as individuals to come together and put our brains together and figure shit out that has never been figured out before, I don't know. Why wouldn't you at least try? That's my question. Why wouldn't you at least try? You only live once. Why not change it for the better? For maybe for the next people that live after you, don't get such a shithole. It's possible, and right now, it's possible more than ever. So, like my dad always said, let's go Brandon. Just kidding. That's really not political. It's just funny.